Hello traders, welcome to my video on Mechanical Forex Trading Strategies. In this video I'm going to share with you a very simple mechanical strategy which you can use to help you capture moves such as this one for over 800 pips and counting. Okay, as I said, this is a very simple strategy that you can use on any trading platform and on any trading instrument. You can use it on major, minor, exotic currency pairs. You can use it on Forex, stocks, cryptos, commodities, indices, etc. Here I have a euro dollar 4-hour chart. I prefer the higher term chart time frame simply because they contain more price data and therefore I find trading signals tend to be much more reliable. So for that reason I focus on the 1 hour, 4-hour, daily, weekly and monthly charts. Okay, I'm not fond of trading the noise on the 1 minute, 5 minute and even 15-minute charts. I'm just not sure why anybody would want to stress themselves out trying to scalp a few pips here and there on the lower term chart timeframes when we can capture big moves like this for hundreds of pips by trading smart, not hard. So mechanical forex strategy is basically a strategy which has a fixed set of rules. Okay, so for instance, if we just place the ADX indicator on the chart, an example of a mechanical strategy would be when the red line crosses the green line in an upwards direction. Just zoom in for you. It suggests a bearish signal. So you can see here the red crosses the green in an upwards direction. It's a bearish signal, and that actually would have been the perfect time to enter this trend. Okay, so that's mechanical because it is what it is. And you could have a fixed take profit of say 50 pips and a stop loss of 20 pips, or a stop loss of 20 pips and a take profit of 200 pips. Or you just exit when there's a cross in the opposite direction, which would be here, which looks in theory like the perfect trade. Okay, that's a mechanical strategy. However, if you were doing that and buying and selling every time the ADX lines crossed for change of trend direction, you can see here you'd be selling, buying, you just be getting chopped in and out of the markets when there's consolidation. So there, okay, here as well, buying, selling. It's just a bit too choppy. Okay, so this is why I don't rely on indicators for trading. Instead, this is my mechanical forex strategy, which works for me, may not work for everybody else, but hear me out. So the first thing to do is you draw your resistance and you draw your support. I mean, that's mechanical enough, right? Everybody can draw support and draw resistance. Granted, can be open to interpretation. I mean, that's how I've drawn the support on an angle like that. Traditionalists may be looking at more immediate support and draw it like that, which is fine. Okay, you don't want to overclutter your charts. But for me, I'm quite happy there with support being that trend line there, resistance being this almost triple top formation up here. Resistance has been tested at least 3 times. You can see prices rejecting and coming back, bouncing back from that resistance level and making lower highs, which suggests a downturn. The market is turning to the downside. And then a breakout of that support line there. If you think a mechanical forex strategy is going to be just buy now, sell now, buy now, sell now, buy now, sell now, I think you've got unrealistic expectations. I do think that you should have some kind of initiative in a trading strategy, but for me, this is as mechanical as it gets. It's simplifying things. Keep it simple, stupid, as they say. Too many traders just clutter their charts with a million different indicators, and it's just a load of noise, especially on the lower term chart time frames, looking for the next crystal ball unicorn indicator that's being sold by someone who's probably not even using it themselves. Okay, so price action trading has been around forever. Candlestick patterns, support, resistance, trend lines, especially on the higher chart time frames, are being watched by big players, and they often have a self-fulfilling prophecy. Not all the time, but that's why we have good money management, which we'll get into as well in a minute. So enough waffling on. Support, resistance, and then we can just establish a trend direction. You can look at a chart and tell me that's moving down. I'm sure we can all look and agree that the chart is moving down, price is moving down. And then we just wait for a pullback. A pullback is basically when there's a reversal. So you can see here, this pullback area. And then you just draw your support line. And the mechanical strategy is to buy on the breakout of that support line. Don't need to overcomplicate things. Good money management and a good entry. You can have the best entry in the world. If your money management is poor, it will have a huge impact on the strategy. So in terms of money management, I placed my stop loss just above a recent high here. It's around 20 pips, which is a relatively tight stop loss for the 4-hour charts. Okay, and then as price falls, say to here, I'll move the stop loss to break even, just lock in the trade. We don't want a winning trade to turn into a losing one. And as price continues to fall down, I just move the stop loss above the highs. So above here, above here, above here, and here, and here, and here. Just maximize the move as much as possible. Last thing I'd want to do is have a 20 pip stop loss, see the price drop around here, see 100 pips, get excited, and just exit the position. You're just leaving way too much on the table. Okay, if we maximize these trends when we catch them, we can afford to take a few losing trades. We can have a 20 pip loss 5 times in a row, be down 100 pips. Because we know that when we capture a big move like this and we get 300 pips, we make back the loss and then a lot more on top as well. Okay, so that just emphasizes the importance of money management. One may argue that as the market starts to make these higher lows here, we could have exited manually, but we probably would have been taken out by a trailing stop. And you may be thinking, well, look, the price continued dropping. Well, we just wait then. We wait for opportunity. When we see this drop here and we see this pullback, what do? Mechanical. We draw our support and we trade a breakout of support. Simple as that. Mechanical. Breakout of support. Arguably here. This is a 4-hour chart, so we know there's plenty of price data included within here. At least, 2 or 3 trading sessions in this area alone. So that's strong support. If you go down to the 1 hour or the 15-minute or lower time frames, you can see this significant level of support, but we just make our life a lot easier by using a 4-hour chart. You see that support even becomes resistance when it's touched here. If you don't want to enter on a breakout because you're scared of a fake out, you just enter on the pullback here, when the pullback of the pullback, if you like, when it touches here. Okay, not every time that will happen, which is why I don't mind taking an initial breakout trade with the stop loss again above the high here, so around 15 to 20 pips, really tight, especially for the 4-hour chart time frame, and the price drops almost 400 pips. Mechanical. Okay. Some may argue, maybe watching this thinking, well, how is that mechanical? Because it's still open to interpretation, but it's just my opinion. I guess if I could give you anything from this video, is that I don't think mechanical is, I don't like to use fixed levels. Okay, why would I say, okay, my stop loss is always 50 pips? Well, in that instance, the stop loss will be up around here. Okay, well, granted, that would give the trade room to breathe, but why? Why would it be up here? Why wouldn't it be above this high? Why wouldn't it be above this high? I like to look at what the market's telling me, and let's just say your mechanical strategy has 100 pip take profit. Great. Okay, so the price moves 100 pips here. You take profit because that's what your mechanical system tells you to do. It's not what the market's telling you to do. Instead, if you moved your stop loss to break even here, and then even when price fell to here, you put a trailing stop above this high here. Okay, locked in 40 to 50 pips profit here. Okay, and then price falls again. Okay, and again. And then you move your stop loss to here. You've locked in 150 pips profit, but you could have taken 300 to 400 instead of your 100 fixed mechanical forex strategy take profit. But everyone's different, each to their own. These are just some principles that I find work for me. Again, mechanical system, market's making lower highs. So what does that mean? We're trending downwards. What do? We wait for a pullback. Where's the pullback there? Breakout of support. Support becomes resistance, continuation. Lower highs, downtrend. Keep an eye on your candlestick patterns. Got a nice engulfing bar there. Lots of bearish indications, a bearish spinning top as well. Bearish inverted hammer. Okay. All the signs are there that the market was going to continue to drop. Even here on this support line, that's an NFP non-farms payroll first Friday of the month candle. I do have a video on the NFP strategy you might want to check out. But you could have even used the momentum from that. If you had an eye on the release and you were expecting it was going to be bearish for the euro dollar, then you could have used that momentum to hop in on this trend at the ideal opportunity, provided your broker's slippage wasn't too inconvenient. Okay, so is that mechanical? What do you think? Let me know in the comments. Let's have a look at a bullish example. Okay, so I'm going to keep it as simple as possible. Support. Trend line, markets making higher lows. Resistance. Breakout. Trade. That's mechanical, no? That's like, it's not really open to interpretation. I guess you could argue where the resistance is drawn. Could be. But if you want to draw it somewhere else, draw it somewhere else. It's a 4-hour chart. You don't need to check your chart all day long. Every 4 hours, every 8 hours, every 16 hours, 12 hours, however often you feel like it. And then when you get in a good position like this, stop loss below the low, 20 pips, really tight on the 4-hour chart, and a profit potential of between 200 and 300 pips again. You can use a break even. As price comes up around here, you could trail below the low there, below the low there, below the low there, below the low there. And then you may look to manually exit when you see these lower highs, and especially this consolidation here. You've got your 3 inside down candlestick pattern there and there. Okay, so the signs were there for a reversal to the downside. Okay, some may have even taken the reversal trade, the M chart pattern there, the lower highs in the breakout. If you missed it, what happens? Pull back in another breakout. This support level is actually, oops, this support level is actually all the way back to here. Strong level, okay? Opportunities are there. You don't need to rely on magical indicators that claim to be crystal balls or unicorns or whatever you want to call them. Trend lines, support, resistance, and knowledge of candlestick patterns, and perhaps most importantly, good money management. But equally as important as good money management is trading discipline. So don't let negative emotions like fear, anger, and greed cloud your trading decisions. Don't have a bad trade and then decide you're going to keep revenge trading, chasing your losses. Try to avoid FOMO, fear of missing out. Don't force trades, don't overtrade. If a trade's not there, don't take it. As I said, you can use this strategy on any trading instrument, any chart time frame, any trading platform. It's pretty simple. And once you see it, I think you're going to realize maybe how you've been looking at trading with lagging and repainted indicators when the price is telling you exactly what the market is doing. Pullback, breakout. There's no coincidence there's a big breakout candle there, let's be honest. What about this one? Pullback, big breakout candle, no coincidence. Okay. Obviously, you don't want to buy too high once you've seen a big uptrend like this. Probably definitely wouldn't want to be buying up around there just as after you've seen a big drop. You wouldn't sell there. Okay. But you will find the odd opportunity on the way down if you're careful. But you don't want to be too late to the party. You have ample opportunity to get in up here. Okay. You can, of course, you can use indicators if you insist. I mean, for this particular strategy, just a moving average on the chart, okay, will tell you the trend direction. And CCI indicator can show you a pullback. And then you can just trade the pullbacks that way, or just draw your support resistance when there is a pullback. Just make sure you've got good money management. Again, I emphasize. Okay. But really, once you know what you're looking for, especially on the higher term chart time frames, you'll find these trades all the time. Look, resistance, markets making lower highs. Okay, so what does that mean? Lower highs, downtrend, draw your support, breakout of support. You can just do this cheeky trade here. Okay. And if you've got good money management, even when you're wrong, you can, get yourself out of trouble. Let's just say for whatever reason, I wouldn't do this just because there's a lot of consolidation around here. But we do get it wrong sometimes. Lower highs and you think we're going to see a nice downtrend, you use this as your support level and you trade this breakout here. Okay, if you're wrong, you're wrong. It doesn't matter. If you see price turn around and start to make higher lows and then continue up, we can just exit. A small loss, 10 pips. Don't even have to wait for it to come if your stop loss is up here. Because then we can just enter on the other side, even on the breakout there, for hundreds of pips. If we don't get the first breakout, wait for the pullback. 250 pips. Then that 10, 15 pip stop loss down here looks minuscule in comparison. This is a bear trap down here. What I believe was happening was people were selling, traders were selling, the price was dropping, and then there's a bit of FOMO down here. People were trying to jump in, trying to be bearish, and what happened? Their stop losses were taken out. Traders who were in earlier were taking profit, and it just caused this shift of momentum to the upside and this big movement there. So this is a bit of a bear trap, so watch out for bear traps, just as you can get bull traps as well. Uptrend there. Whoever's buying around here is buying at the high. Stop loss is taken out. Traders who are in here are taking profits up and around here. You just get this big shift of momentum to the downside. That is trading for you. Hopefully you found something useful in this video. I do appreciate you watching. If you can like and subscribe, that will really help my channel. And I hope to catch you on the next one. Take care.